In trading, one of the best entry models is a sharp turn, but you need to know how to properly use it. So in this video, in 5 steps, we are going to cover how you can use a sharp turn to your advantage. The first step before we even get close to a sharp turn is finding a bias, a draw on liquidity. So where is price most likely heading towards? Here on CHF-JPY, where I personally also took a trade, which I'll show you in a little bit, we can see that we have a weekly fair value gap right there continuing lower. Off of that weekly fair value gap, it seems like we are respecting that with a long wick at the top. From that, we can potentially continue lower. That is the first step already done. We can continue lower. Second step is when you find a direction where price is most likely heading towards, find a fair value gap towards your bias. So here we can potentially be bearish. Now I want to go down time frames because on the weekly we don't have a new fair value gap just yet. And I want to find a new bearish fair value gap. So I go onto the daily. On the daily right here, we see a very small fair value gap right there, which we can potentially continue lower from. It's overlapping with this order block right there as well. Now this right here creates a context area. And a context area is the premium array where you are expecting lower prices from, is where you can go into the lower time frame potentially to look for your trade ID. But until when can you actually look for entries? You can look for entries until we reach the first opposing discount array right there. This area from that premium rate towards that discount rate right there, that creates a context area. In that area, you can safely go down time frames to look for your entry. If we go down a singular time frame right here on the 4 hour, then on the 4 hour, once we come into that daily premium rate right there, that line, we see right here that coming into that premium rate on the 4 hour, we actually have a fair value gap pushing into that. And then after a while, once we sweep these highs right there, we create a fair value gap going out of that. So a fair value gap actually going lower right there. This creates a fair value gap into the premium rate and a fair value gap out of the premium rate. That is the definition of a sharp turn. Now there's different types of sharp turns because this is just one example of a sharp turn. There are good sharp turns and there are also bad sharp turns. And I'll cover them all. All the sharp turns start with a PD rate that we are either going higher off of or lower off of. A sharp turn in the middle of nowhere, so for example this right here, you could label this as a sharp turn, yes, but it's not coming off of any significant premium rate. So that is not a sharp turn where you want to actively look for a trade ID. There needs to be first step bias and second step, there needs to be a fair value gap towards your bias. So here, if we want to continue lower and we still have this as our bias, then what is now a fair value gap pushing towards that bias? Well, this 4 hour fair value gap right there. Where off of that 4 hour fair value gap, we create new context where now the first discount array that we are actually approaching is this previous candle low right there. That creates again a new context area. Now, if we go down another time frame, then on the 1 hour time frame, we see that we are again creating a new fair value gap lower. So again, in the direction of our overall bias. Right here, we create a 1 hour fair value gap right there lower. Funny thing, off of this 4 hour fair value gap right there, which we were expecting lower prices off of, we also create a new sharp turn where we have this 1 hour fair value gap right there higher and 1 hour fair value gap lower, fair value gap in, fair value gap out. The fair value gap in is ideally in the most recent range. So what is the range? If we're talking about a bullish range, we are talking about swing low towards a swing high. If we're talking about a bearish range, we are talking about swing high towards a swing low. So this right here is the most recent range from this low right there towards that high. That range is the cause that we push into this 4 hour fair value gap. In that range, we have a fair value gap sitting right there. Why do we want to see a fair value gap going against our initial bias? Well, that is because in the market, fair value gaps are used to show intention. And when people think fair value gaps are shown as intention, that can also, of course, be used against us as manipulation. Where during a sharp turn, fair value gaps are first used as manipulation to then show the real intention. Why is that happening? Well, we are simply trapping people towards the wrong side of the market right there to use their liquidity to then get involved on the opposite side. That is exactly why sharp turns work so well. We first trap people and then we get the real intention in the market. But that's only the first part of a sharp turn, because now, of course, when we want to look for an actual entry, we need to understand the third step. And the third step is understanding time frame alignment. In previous videos, I have gone over different time frame alignments as well. When we're talking about a sharp turn entry model, the time frames need to be closer to each other. Why? The PD rate that you are looking to confirm has a certain time frame. So right here, let's take this 1 hour fair value gap right there, where I actually took the entry. Then that PD rate, where we can continue lower off of, is on a 1 hour time frame. Inside that premium rate, we will look for a sharp turn on the lower time frame. The closer two time frames are to each other, the less confirmation you are going to need and the higher probability the confirmation is also going to be. So for example, if we have a 1 hour premium rate that we are looking to confirm on the lower time frame, then the further the entry time frame is going to be from that 1 hour time frame, the more confirmation you are going to need. So the closer the PD rate time frame and your entry time frame are to each other, the less confirmation and the higher probability your entry confirmation is going to be. So if we have a 1 hour PD rate right there and we are looking at a 1 minute sharp turn, that's not quite enough. Then we would need another fair value gap lower instead of just a sharp turn. But if we're looking at a 1 hour and a 5 minute fair value gap, 5 minute sharp turn, that is going to be enough. Then of course, if we're looking at a 1 hour premium rate and then a 15 minute sharp turn, that's going to be even higher probability than the 5 minute sharp turn. But 15 minute sharp turn of a 1 hour premium rate, you might sometimes miss the move because before we get the sharp turn and before we are outside of that context area, first discount rate right there that we will reach, we might get the 15 minute sharp turn quite late. So time frame alignment for a sharp turn is a general rule of thumb. And again, you can always go up in time frame to get more confirmation. For example, off of that daily fair value gap that we had marked out earlier, I went into the 4 hour for a sharp turn because I want more confirmation. If you're just starting out and trying to master sharp term entries, then there's nothing wrong with more confirmation. But there's a whole lot of things wrong with less confirmations because that's when you get burned. That's when you're going to blow accounts. So third step is understanding the time frame alignment. And the time frame alignment is the following. We have monthly PD rate. I want to look for a daily sharp turn. Weekly, 4 hour. Daily, 1 hour, 4 hour, 15 minute, 1 hour, the 5 minute. And if you're looking at scalping, then for the 15 minute PD rates, I am looking at a 1 minute sharp turn. So before we dive into the lower time frame, let's retrace the steps. We have our bias. We have now a premium rate, fair value gap that we can continue lower from. So bias and a fair value gap in the direction of our bias. Third step, we understand the time frame alignment. So we understand into which time frame we should ideally go from now. Again, we are always looking to trade inside that context area. When we move outside a certain context area, I want new context to then look for a new entry again. So this 4 hour value gap that we had earlier right here had context from that premium rate towards this discount rate right there. Why am I using a previous candle low and not a swing low like I'm using in other examples? If there is a previous candle low but also swing low directly followed, then I use the swing low instead. If there's only a previous candle low at this moment in time, then I use the previous candle low. That creates a context area from that premium rate towards that previous candle low. When we move below that previous candle low, context has been taken, meaning original entries that we had right there, I'm not interested in that anymore. I want new context. New context is found right here on the 1 hour. We have this 1 hour value gap, which we can continue lower from. What is the first discount rate that we encounter? That swing low right there. So this area right there is where I want to look for my sharp turn if I do want to take an entry as well. Third step is again that time frame alignment. So of that 1 hour value gap, I now understand, all right, I want to go into the 5 minute time frame. Now we're getting into the specifics because there's different types of sharp turns. As I mentioned earlier in this video with a quick sneak peek, a sharp turn is a fair value gap in and a fair value gap out. Now, oftentimes people mistake a sharp turn for a BPR. A BPR is a concept by ICT, which essentially is overlapping fair value gaps. So this, for example, is a balanced price range. It's a BPR right there. Now, a sharp turn is not a BPR. Otherwise, I would have named it a BPR. A BPR is always a sharp turn, but a sharp turn is not always a BPR. And let me explain why. First step is again understanding that we have a premium rate that we can actually continue lower from. Just trading sharp turns in the middle of nowhere without any context, without any bias, that's going to be so detrimental. And I see that mistake too often. The focus for a sharp turn. First step again, premium rate. Then we have a fair value gap in. That fair value gap in is ideally in the most recent leg right there. So this is a recent leg. We have fair value gap. We have manipulation into our premium rate. Perfect. After that, Third step, we have a fair value gap coming out of that premium array right there. This doesn't have to be overlapping fair value gaps. It can be, yes, but it doesn't have to be. Now, right here, we actually see something that I even prefer almost over an overlapping fair value gap, is we have an order flow transition. The definition of order flow is PD arrays holding towards one side of the market. Meaning, if order flow is bullish, we have discount arrays holding towards that side of the market, meaning that creates a bullish trend as well. Now, bullish order flow right here is also seen through those fair value gaps. So whilst coming into that premium array, we always have bullish order flow right there on the 5 minute. Where if we want to continue higher and we want to continue this bullish order flow, then what should the 5 minute ideally do right here? The 5 minute off of this fair value gap should now create a new fair value gap higher off that previous fair value gap to continue a new order flow leg higher, which we can see that does not actually happen. That is perfect because now we failed to create a bullish fair value gap higher right there. And instead of that previous fair value gap right there fails to create a new bullish fair value gap, we create a bearish fair value gap right here. That is the first part of an order flow transition, which happens through a sharp turn as well, an ST as I like to refer to it. An ST is simply a sharp turn. When you have that visual order flow transition right there, that's arguably even stronger than just a sharp turn which have overlapping fair value gaps. So right here, after the third candle closes, right there, that creates a sharp turn where the full area of the sharp turn is now this whole area right there. So what is our entry going to be? Our entry is going to be determined by if the sharp turn right there and the bearish fair value gap, so the last fair value gap of that sharp turn, is a breakaway gap or a fair value gap. And the reason why we need to determine that is because we need to understand, are we actually going to retrace back into that fair value gap, or are we already going to continue lower instead? And that is determined by the third candle of that fair value gap. The third candle of any fair value gap will most likely tell you if it is going to be a breakaway gap or a fair value gap which we can trade back into. As a general rule of thumb, and it's extremely general, if we close below the second candle low right there of a fair value gap, it is most likely a breakaway gap. If the third candle is already a new expansion phase candle, so like the second candle, it's an expansion phase. I'll show you a different example later on. Then that is exactly what determines it to be a breakaway gap. The third candle is ideally somewhat of an up candle or a consolidating candle. That is when we can confidently say, all right, we might want to trade back into that fair value gap. So we can already look to enter off of that fair value gap right there. Place a limit order, whatever it may be, or of course, market execution if you do prefer that, and then wait for your order to get filled. Of course, that is one part of understanding the entry, because with an entry, there's also a stop loss involved. So where do you place your stop loss? If you are just starting out with sharp turn entries, take the beginner path. You don't need to get into the advanced stuff just yet because it might just burn you. And that is not what we want. So right here, the beginner step for a stop loss is simply covering the sharp turn high right there, which is the swing high, the highest swing high before we actually get that last fair value gap lower right there. But as you may see, this stop loss placement it's quite a big stop loss in my opinion. Again, there's nothing wrong with it if you're holding that for quite a while, but I think we can refine that because I believe the low probability conditions do not start above that swing high. They already start above the bodies right there, above the bodies of the sharp turn that was created. Then once we have our stop loss in place, we have our entry in place, we of course need a take profit. A take profit is ideally just simply a 1 to 2 right there. Ideally even within the context. If it's just below it, it's perfectly fine as well. Start off with a 1 to 2 take profit, then eventually you can potentially as well build onto that. Where here, of course, I took this entry as well, where we eventually deliver lower right there towards the take profit right there. Where the original daily context that we don't even follow through fully, so we don't even reach the lows right there, that doesn't really matter because I'm not reliant on that as well. Now, like I mentioned, there's different types of sharp turns, there's different confirmations. So let's look at that. Here, if we want to continue higher, we have this weekly fair value gap right there. As easy as it can be. That weekly value gap is a discount array. The first premium array we encounter is this swing high right there. Off of that weekly value gap, you can potentially already go into the 4 hour to look for a 4 hour sharp turn. So if we look at a similar sharp turn right here that we saw in the previous example as well, we have the fair value gap in right there in the most recent leg. That fair value gap actually, order flow transition, fails to create a new fair value gap lower, then creates a bullish fair value gap. That's such a good sharp turn. That's exactly what you would want to see. Then right here, this bullish fair value gap is actually a breakaway gap right now, because the third candle is an expansion candle. It's already pushing higher. So it's not very likely that we are going to trade back into that fair value gap. So in a scenario like this, where we leave behind a breakaway gap as our sharp turn entry, I like to enter already on the close of the third candle right there, covering, again, the body's covering even that low right there is perfectly fine. Since that is a breakaway gap, the probabilities are that we might actually not retrace into that fair value gap. So yes, can we wait for that next fair value gap? But at the moment in time and not in hindsight, then of course, at this moment in time, all we're seeing is a run. So we might actually want to keep on running right there. So I already want to get involved. Now I do this when a 1 to 2 RR right here inside the context area. So what is the context area again? It's from this discount rate towards this premium rate. When a 1 to 2 RR is easily achievable within the context area, then entering on the fair value gap creation itself is perfectly fine. So as you can see, this whole area is where I want to potentially look for entries. Does that mean I need to target that whole area? No. A 1 to 2 is even a higher probability when it's very small compared to the overall context area where you can potentially target as well. The further you are targeting, so if I'm targeting like this, the lower the probability that we will actually reach that before I get taken out. Simply said, because when you are demanding a lot of a price and you are demanding a very far target, it's quite low probability that we will achieve that. Of course, closer targets are easier because they are indeed closer. Now, eventually, once we deliver higher right there, what do we see on the daily time frame? On the daily time frame right here, we actually see also a new sharp turn being created, where this sharp turn does in fact have overlapping fair value gaps right there. That is also, yes, it is a good fair value gap right there. Then this sharp turn does in fact have overlapping fair value gaps right there, which also creates a good sharp turn. And once we create this sharp turn, a daily sharp turn off of a weekly discount array, that's extremely high probability because those time frames are very close to each other. Then this daily sharp turn, you can enter off of that, but you don't need to. You can, of course, confirm it through and through and through again. Where right here, once we deliver into that daily fair value gap, we can go into the 1 hour time frame as well to now look for a new sharp turn, where we have a sharp turn like this. Fair value gap into the daily discount rate and fair value gap out of the daily discount rate right there as well. Now this sharp turn, in all honesty, is a little bit lower probability. And the reason why I mentioned that is because we have a fair value gap in to the daily discount rate and a fair value gap out of the daily discount rate right there as well. But even there, you can require more confirmation off of this as well, where off of that 1 hour sharp turn, you can again go into the 5 minutes to look for a 5 minute sharp turn. If you notice that your ST is failing quite a lot and is not holding quite a lot, that usually is because the higher time frame, so the discount rate you are trading off, is the more important part. The sharp turn is just the confirmation off of that discount rate. If you can pick out the good PD rates where we can actually continue higher or lower off of, that's the key. But if you struggle with that, that's also perfectly fine, because then instead of the 1 hour right here, go up a singular time frame. Again, wait for that more confirmation, where this 4 hour sharp turn is also a perfectly fine entry. But if you do not want to take a 4 hour sharp turn, then what can you do? Well, of that 4 hour sharp turn, you can again confirm it again. So we can go into the 15 minute time frame, the time frame alignment again. What do we see here? We have a 15 minute fair value gap coming into that 4 hour fair value gap right there. We have, I like this one the most. We have this order flow transition right there, failing to create a new fair value gap lower, and that creates a new fair value gap right there going higher. This for me would have been a breakaway gap entry right there to then cover the lows, cover that even. But at this moment in time, covering the lows, a little bit bigger stop loss. Oftentimes a bigger stop loss is not necessarily a bad thing. Just allow your higher time frame to play out, and then targeting a 1 to 2, where you are targeting a 1 to 2 inside still the weekly context that we had right there. Again, once you get to the more advanced understanding, you get more experience, trades like this eventually are where you can let them run for very, very long. Again, do they happen often? Absolutely not. But once they happen, you can capitalize on them and you can now recognize them as well. This is how you take advantage of a sharp turn trading model. Now, if you also want to take advantage of the current live spring enrollment that we have in the money making team, then please feel free to check that out as well. Link in the description. All right, perfect. Thank you.